Welcome back to Yahoo Finance Live, everyone. Earnings season yielding overall better than expected results. Alongside optimism, the Fed might ease up on aggressive hiking, but gloomy company forecasts could mean a still depressed outlook for investors. So have markets priced in their fears? Joining us with more, we've got Ben Snider, Goldman Sachs U.S. Portfolio Strategy Macro Team Senior Strategist. Okay, so Ben, first and foremost, it's been better than expected, but it's largely off of some of the forecasts that had already been dampened coming into this earnings season. So perhaps relief is the word that we should be using here.
Yes, I think it's hard to look at the earnings season and call it a spectacular success. But as you pointed out, everything in the markets is about expectations. And results so far have been better than feared. Now, if you look at analyst estimates at the start of the season, the consensus was expecting earnings growth of about 6% year over year. So far, we're just about halfway through the season, and it looks like we're tracking for about 8% year over year. Now, if you pull out the energy sector, which of course has benefited from very strong oil prices, analysts expected growth of down 3%, that is negative 3% year over year. We're tracking about negative 2%. So not fantastic in absolute terms, but better than feared is a good way to describe it.
Ben, are markets just too optimistic?
I think it's hard to argue that markets are too optimistic today. One of our favorite tools to track growth expectations in the equity market is comparing the performance of cyclical industries relative to defensive industries. If you look at that rotation within the U.S. equity market, defensives have massively outperformed this year, as they often do when the market is concerned about economic growth. And in rough terms, you can look at those stock prices, and it suggests the market is pricing an ISM index, for example, of around 50, or in terms of U.S. real GDP growth, roughly 0 or 1% growth. So it looks to us like the market is already pricing a pretty negative economic growth environment. I think it's hard to say markets are too optimistic today.
This is really interesting, Ben. So it sounds like if one was to look at just the broad market to make a conclusion about whether folks are pricing in a certain economic scenario, that would be an oversimplification, that you really need to dig down into what is moving and not just say the level of the S&P 500.
You're right. There are many ways to examine what's going on in the market. And actually, the point you make, the difference between what the headline index is suggesting and what is being suggested underneath the surface of the market is a particularly interesting divergence today. So, for example, if you look at the headline level of the S&P 500, one of the more surprising things to investors in our client conversations is that all of the 24% S&P 500 decline in the first half of this year was driven by valuations. So despite plenty of headlines about consumer confidence and recession fears, really the entire decline was driven by lower multiples on the back of higher interest rates. And conversely, the 12 or 13% rally we've seen in the last 6 weeks has been driven by the decline in interest rates and recovery in valuations. So if you were just to look at the overall equity market, you would say really what's been going on is a reflection of Fed policy and interest rate policy. But once you start to dig in a little deeper and you look at the performance of sectors and industries and thematic baskets, it's pretty clear the market has priced a substantial deceleration in growth, just as we've seen in the economic data.
I like one of the recent screens you and your team did recently, Ben, identifying 18 growth stocks with a near-term path to profitability. So a couple names on this list, like a Lyft was mentioned on here, Riot Blockchain. But is the theme there that growth stocks could be a good contrarian investment here?
Just mentioned the importance of interest rates on driving the overall market this year. But it's not just the overall market, of course, that depends on interest rates. In particular, growth stocks have been extremely sensitive to the interest rate environment. And so while the S&P was down 24% at its trough earlier this year, some of the stocks with the fastest expected revenue growth had declined by much more. And so that potentially presents an opportunity for investors looking for some high quality stocks that are going to grow in the future, but have been really punished as a result of the rate environment. That said, there's still a lot of economic uncertainty. There's still a lot of uncertainty about the funding environment, given how tight capital markets have been so far this year. And so for us, if we're looking at the universe of growth stocks, we want to make sure that those stocks are on the path to actually generate earnings, which seems to be a quality that the market has rewarded so far this year.
Even within the high quality stocks that you're looking for right now, it seems like you're looking for those companies that have pricing power Where does that pricing power start to diminish as the consumer is even more concentrated and focused with the dollars that they're spending? And even on the business side, for the B2B side of that spending, you're seeing businesses restructure a lot of their costs right now.
This has absolutely been a key theme of the earnings season so far. You're completely right. Part of the reason why the multiple and rates have driven markets this year is that we haven't seen any reduction to earnings estimates for the first 6 months of the year. And that was pretty surprising at a time when the S&P was declining as it was. But if you look in the last few weeks, since the start of the second quarter earnings reports, we have started to see analysts cut their estimates. In fact, we've seen 2023 consensus earnings estimates for the S&P 500 fall by about $5 or 2% in the last few weeks. And if you look at these cuts, they've primarily been driven by profit margins. That is, it finally looks like after hitting a record level in 2021, profit margins are starting to recede a bit as revenue growth slows, but companies still struggle with tremendous input cost pressure. And so I think the clear solution for investors is to find companies with robust margins and high pricing power that can maintain those elevated levels of profitability despite the fact that revenue growth is slowing and input cost pressures, whether wages, commodities, logistics, et cetera, remain elevated. That's been one of our favorite strategies, and we continue to like those as we look in the remainder of the year.
Real helpful analysis here this morning for us. Ben Snider, Goldman Sachs U.S. Portfolio Strategy Macro Team Senior Strategist. Good to see you. Talk to you soon.